Gold heads into Thursday the 9th of July at a critical crossroad. The Iran ceasefire has collapsed, U.S. strikes hit over 80 targets across Iran, and the FOMC minutes just printed hawkish. Gold is pinned under 4,200, but the safe haven bid is very much alive. First, the snapshot. Spot gold is trading near 41.20 to 41.50, digesting hawkish FOMC minutes from Wednesday. The RSI is around 44 to 50, a genuinely neutral reading with no clear directional edge. This week's high was 41.88 from the 4th of July, and the Tuesday print was around 41.80. Near-term bias is neutral bullish, caught between a reignited war and a firming US dollar. Two-way tape, respect the levels. The big picture. Gold is caught between two powerful forces. First, the Iran ceasefire has collapsed. CENTCOM struck over 80 targets inside Iran after Tehran hit 3 Hormuz tankers. Trump declared the Islamabad memorandum quote over. That safe haven driver is dominant. Second, the FOMC minutes read hawkish. 9 of 18 officials see at least one more hike. Year-end rates near 4%, dollar firming. These two forces are pulling gold in opposite directions, creating a tightly coiled two-way tape with elevated headline risk. What changed? Two major events drove the tape. The Iran ceasefire collapsed decisively. U.S. strikes on over 80 targets, Trump declaring the Mao over. And the FOMC minutes read hawkish, a 9-9 hike split with Chair Warsh withholding his dot. Gold poked up to 41.80 but remains capped under 4,200. The PBOC added 14.9 tons in June, the largest single month since 2023. We now have a genuine two-way tape. War bid versus hawkish USD. Geopolitics is the dominant story right now. The Iran war that first drove gold above 5,300 has decisively re-escalated. The June 17th Islamabad memorandum is effectively dead. After Iran struck 3 oil tankers in the Strait of Hormuz on Tuesday, CENTCOM launched powerful strikes on over 80 targets across Iran. President Trump at the NATO summit in Ankara declared the Mao over and called further talks a waste of time. This was the third U.S. attack during active negotiations. Tehran is now barring IAEA inspectors from bombed nuclear sites, and Israel is actively bombing Lebanon. A three-way escalation that is very much live. The safe haven bid is dominant, and this is the main driver for gold right now. On the macro side, the Fed held rates at 3.5 to 3.75% in June. Unanimous 12-0 decision, but the dot plot turned hawkish. 9 of 18 officials see at least one more hike. The minutes confirm that tone. Year-end Fed funds futures near 4%, July odds about 22%, September around 56%. DXY firming near 100.9. The Fed is the ceiling capping gold below 4,200. Geopolitics is the floor, and right now the floor feels more active. Inflation remains sticky. May headline CPI ran 4.2% year-on-year, the highest since April 2023. Cleveland Fed June nowcast near 3.96, a slight cool, but the wild card is oil. Hormuz tanker strikes have firmed crude, threatening to reopen the energy pass-through that had been easing. One-year inflation expectations sit at 3.7%. June CPI due Monday the 14th, and with oil firming on war risk, this print takes on extra significance. The calendar for Thursday the 9th. Weekly jobless claims, prior 215,000. A jump would reinforce the cooling jobs narrative from last week's soft NFP and would be supportive for gold. Iran headlines continue driving intraday volatility. June CPI lands Monday the 14th. Elevated two-way volatility as the market digests hawkish minutes against a backdrop of reignited war. Technically, the short-term trend is consolidating between the 41.14 hammer pivot and the 42.02 cap. No clear breakout. The higher time frame remains bearish, price below the 50-day moving average at 43.74 and the 200-day at 44.91. Key pivot is 41.14, the must-hold support shelf. First caps at 42.02, then 42.55 and 43.14. Coiling, not breaking, and favoring range-based approaches. Momentum is genuinely neutral. The RSI around 44 to 50, hovering near the midline. MACD moving sideways in negative territory, consistent with a consolidation phase, not a trend. Price trading between VWAP and the 20-day moving average, a balanced tug-of-war between buyers and sellers. This is not a trending market. It is coiling and compressing. The setup favors range trading strategies around established support and resistance. Resistance levels on the upside. 41.57 is the first cap, having flipped from support to resistance. 42.02 is the psychological key hurdle. Above that 42.55 swing resistance, then 43.14 daily high projection. The major structural cap is the 200-day moving average at 43.76. Support levels on the downside. 41.14 the hammer, the must-hold pivot. Below that 40.60 is the projected daily low and bounce base. Then 40.08 at the 4,000 line, and 39.52 the weekly low and rally origin. 38.94 if that level fails. Hold 41.14 and the range is intact. Lose it and the path lower opens up. Projected ranges for Thursday. The daily range is 40.08 to 42.55, wide on claims plus Hormuz volatility. Near-term consolidation band sits at 41.14 to 42.02. For the week of the 6th to 12th, 38.94 to 43.76, a two-sided headline-driven tape. The bull path runs 41.14 through 42.02 to 42.55, then 43.14. The bear path unwinds 41.14 down to 40.60, 40.08, and 39.52. Scenario 8 at 37%. Bullish. Trigger is further Iran strikes or a soft claims print. Path holds 41.14, reclaims 41.57, and tests 42.02, then 42.55 and 43.14. Strategy is to buy dips near 41.14 and at above 41.57. Scenario B at 40%, the primary path. Consolidation. The war bid balances the firm dollar, keeping gold between 41.14 and 42.02. RSI neutral, two-way and headline sensitive. Strategy is to fade the 4200 zone and buy dips that hold 41.14. Patience and range discipline. Scenario C at 23%. Bearish. Hawkish digestion continues. Low claims, quick Hormuz de-escalation. Loss of 41.14 reopens 40.60, then 40.08 and 39.52. The 50 and 200-day moving averages keep the broader trend bearish. Strategy is to sell failure below 41.14. Beneath all the headline noise, structural central bank demand provides a solid floor beneath the market. The PBOC has bought gold for 20 consecutive months, the longest streak since 2015, lifting reserves to about 2,346 tons. June alone added 14.9 tons, the largest single month since 2023. Year-to-date accumulation is about 40 tons, with clear evidence they are buying the dip below 4,200. Global central bank demand has been running at roughly 1,000 tons per year since 2022, double the prior decade average. This structural buying is exactly why the 3950 to 4100 zone has attracted consistent value bids every time price dips into that area. The bottom line for Thursday the 9th. Near-term bias neutral bullish. Reignited war and PBOC buying underpinned dips, hawkish Fed caps rallies. Pivot is 41.14. Above it the range is intact toward 42.02. Below it the fade targets are 40.60, 40.08, and 39.52. Swing factors are Iran headlines, jobless claims, and post-minutes dollar dynamics. Trade the levels. This is the resistance map for today. The price ladder runs from 41.57 as the first cap, through 42.02 as the key psychological level, then 42.55, 43.14, and the 50-day moving average at 43.76. That is your gold daily outlook for Thursday, the 9th of July. War is live, the Fed is hawkish, the range is defined. Respect the levels, trade what you see, not what you feel. Like, subscribe, and turn on alerts. This is for educational purposes only, not financial advice. Trade safe.